Welcome to The Explainer, where today we're looking at the quiet path to wealth, the index fund strategy. So let's just dive right into it. We're looking at a surprisingly unglamorous, yet absolutely incredible financial tool, the index fund. We're going to explore exactly how it quietly builds long-term wealth. And to kick things off, I want you to picture a classic race right off the starting line. Imagine two people starting this race. On one hand, we've got a frantic runner who's just sprinting as fast as possible, right? They're changing lanes every few seconds, desperately looking for some shortcut to jump ahead of the pack. Then we have a totally different kind of runner. This person just chooses a steady, manageable pace, locks it in, and literally never stops moving forward. Now, at first, that frantic sprinter seems way ahead. They're creating a lot of action and excitement. But years later, it's the steady runner who quietly crosses the finish line first. And you know what? Building wealth works exactly the same way. A lot of people spend years exhausting themselves, chasing the next hot stock or financial trend, while others quietly become wealthy without ever making a flashy headline. To see how this actually plays out in the real world, let's compare two 29-year-old software engineers. They both earn the exact same salary, but they have radically different investment philosophies. Let's call them Ethan and Maya. Now, Ethan, he loves the excitement. He chases trends, he trades weekly, and he's constantly consuming market news. It leaves him perpetually one bad headline away from a total meltdown. Maya, on the other hand, takes a completely different approach. She opts for a broad fund, automates her investments, completely ignores the daily market noise, and remains totally relaxed. While Ethan treats the stock market like this daily stress-inducing roller coaster, Maya took just one single weekend to learn about index funds and set up an incredibly simple three-step strategy. Step 1, choose a broad market index fund. Step 2, set up an automatic monthly investment. And Step 3, close the app, walk away, and just live your life. She isn't constantly tinkering. She made a solid plan and she let the automation completely take over. To really understand the core mechanic of Maya's index fund, imagine walking into the world's largest fruit market. You could spend hours, literally hours, agonizing over trying to choose the single sweetest apple or the absolute perfect mango. That's exactly what picking individual stocks is like. But the index fund approach is entirely different. Instead of stressing over picking one winning piece of fruit, she is simply buying a pre-made basket that contains a little bit of everything. Basically, she's buying the whole market. Let's look at another way to think about this. Imagine you're managing a football team. Would you place all your hopes on one single star player? Probably not, right? Because if you put all your money on that one player and they have a bad day or get injured, your whole team loses. That is exactly why championship teams rely on a collective effort. Everyone from the goalkeeper to the defenders to the forwards, all working together to win the game. And this brilliantly illustrates the concept of diversification. An index fund operates just like that championship football team. It doesn't depend on a single company to secure a win for your portfolio. Instead, it spreads your money out across many different businesses. So if one company in the fund struggles or has a bad year, well, others might perform exceptionally well and carry the weight. It essentially protects your overall investment from a catastrophic loss. Now contrast Maya's diversified calm with Ethan's chaotic daily timeline. Every single morning, Ethan is checking stock prices before he even gets out of bed. By lunch, he's frantically reading market news. And at night, instead of relaxing, he's up watching videos predicting tomorrow's market winners. It's this relentless cycle that demands his constant attention, and it just leaves him oscillating back and forth between a temporary high of excitement and the deep lows of extreme stress. We can think of Ethan's active trading like betting his entire year's harvest on one single apple tree. If a disease hits that specific tree, he literally loses everything. Maya's index fund strategy, however, is like owning the entire orchard. Sure, some trees are going to produce more apples, some will produce fewer, and a few might even die off completely. But because she owns the whole orchard, it continues producing a reliable, steady fruit harvest for her year after year. So the really crucial point here is that as 5 years pass, the market inevitably changes. Ethan is spending hours agonizing over these shifts, constantly trying to guess what to buy next as companies merge or fail. But Maya's fund, it acts as a self-cleansing mechanism. It automatically drops weaker businesses that shrink or leave the index, and it adopts the invisible winners, the new successful businesses entering the evolving economy. Her portfolio naturally evolves, and she doesn't have to lift a single finger to make it happen. Ethan is basically exhausting himself navigating what feels like a chaotic staircase of trades. Every few steps, he has to stop, evaluate, change direction, and start his momentum all over again. Maya, on the other hand, is simply riding escalator. Yes, she had to exert the initial effort to take that first step and set up her consistent investment plan. But once she did, the steady movement of the escalator just carries her steadily forward, upward, and onward. All of this steady movement unlocks the absolute massive advantage of compound growth. Every month, Maya automatically invests. Companies pay dividends, businesses increase in value, and all of those returns get reinvested. Eventually, her returns actually begin earning their own returns. Maya isn't working longer hours at her software engineering job, but her money is working around the clock. And the longer she stays on that escalator, the more her investments multiply entirely on their own. Now, let's fast forward 20 whole years into the future, to when our two software engineers, Maya and Ethan, finally meet up again to catch up on life and compare where they've ended up. Their two-decade reunion reveals a pretty stark contrast. Ethan looks back and remembers thousands of hours wasted on hundreds of trades, countless failed predictions, and agonizing sleepless nights during inevitable market crashes. He is just exhausted by years of market anxiety. Maya's memory of the last 20 years looks very different. Her passive strategy allowed her to focus on building her career, enjoying her hobbies, and actually spending quality time with her family. In fact, during all those years, the only thing Maya really remembers about her investment portfolio is this exact phrase popping up as a quiet, automated monthly notification on her phone. Your investment has been completed. That's it. No drama, no panic selling, just a quiet, boring notification that over 2 decades steadily built her an absolute fortune. While index funds certainly won't make flashy news headlines, they quietly build immense wealth because they rely on 5 core pillars. First, regular, disciplined investing. Next, keeping your investment costs and fees relatively low compared to active trading. Third, extremely broad market diversification. Fourth, allowing compound growth to do the heavy lifting over decades. And finally, perhaps most importantly, completely removing human emotion and unnecessary trading from the equation. What you really should take away from all of this is that ultimately the goal of investing isn't to be some kind of psychic who guesses tomorrow's superstar stock. The goal is simply to own a tiny piece of all the businesses that are actively creating value right now. Through an index fund, you own a fraction of every new smartphone sold, every bridge built, every breakthrough medicine developed, and every major innovation that comes to market. You are quite literally buying a piece of tomorrow's world. I'll leave you with this final thought, drawn straight from our source material. The biggest surprise isn't that index funds build wealth, it's that they do it so quietly that most people don't even notice until it's too late. Could stepping off the thrilling, exhausting roller coaster and embracing a brilliantly boring, automated path be your ultimate secret to building lasting wealth? Sometimes the simplest strategy really is the most powerful. So, what other areas of your financial life could benefit from the brilliantly boring approach?